Hello, this is Dale. What I'm going to do in this video is go over two profitable trades we got out of just yesterday and this morning. One was in Costco. It was a leap credit spread, and the other was in the SPX, which was a monthly credit spread. My name is Dale Brethauer. I've been a trader for 35 plus years, hedge fund manager, been a guest speaker at a number of platforms, written 3 financial books, and I am the founder of what I believe to be the best educational website for options available today, www.optionsinfinity.com. We focus on credit spreads because I happen to believe that credit spreads are the very best way to bring in monthly income on a consistent basis. You get great returns, and it's coupled with a high probability of success. When we do credit spreads, you're the seller, you're selling premium. So the theta decay or the premium decay over time is working in your advantage. Whereas if you were buying a put or a call, if it goes in that direction within a certain time frame, you do okay. But if it doesn't, you can lose everything you have. Whereas with a credit spread, you can win if you put on a bull put, which is a bullish strategy, which you put on by selling an option out of the money and buying one further out of the money. If the price goes up, you win. If the price goes sideways, you win. And if the price goes down a slight bit, you win. So there's 3 ways to win. All the time, the time value is decaying, and you're winning in that manner too. You don't have to be a chart hawker. You don't have to watch the market constantly. It's a low anxiety way of trading. And because we're selling and then buying one further out of the money, you have a protection against loss. A lot of people look at the high premiums you can get when you sell, and you say, well, why don't you just sell naked? That actually requires a lot of margin by the floor traders because they know how risky it is. And based on the margin required, you actually get a better percent return when you do credit spreads, and you are protected against that catastrophic loss. In this chart, what I'm showing is the rapid option decay, the time decay, the premium decay in the last 30 days of an option. This is where we are focusing. And time is in our favor versus buying directly, where it has to move in the direction you want within a quick period of time. Here, time is to our advantage. Again, a bear call is a type of option strategy used when a decline in price of the underlying asset is expected. So the operative word here is bear. It's a bearish strategy. And what you're doing is you are selling a call, and then you're buying a call further out of the money to set up your bear call. With a bull put, the operative word here is bull. This is a bullish strategy. You're looking for a rise in the price, or in both these cases, if it just stays constant or comes down a little bit, you can profit. With the bull put, what you're doing is you're selling an out of the money put and then buying one further out of the money for protection. Now, the two strategies we just got out of, the profitable strategies, were both bull puts. This first one was on Costco, and in the middle, you can see the chart of Costco. And the first thing you probably are wondering is, what are all these lines you have on the chart? Well, this line right here is what's called the regression line, and it is calculated by taking 50% of the price below and 50% of the price above. The regression line can be done for any time frame, and I'm just showing you a truncated section of this, but the green is a plus or minus 1 standard deviation, and the gold is plus or minus 2 standard deviation. Statistically, 95% of all prices will be contained within the gold and about 66 within the green. This is a very powerful tool. I use it all the time. What we have here is a measured move. So in other words, the price has come up, then pulled back, but made a higher low and then made a higher high right here. That's when we want to get in. This is the 5-day and the 8-day exponential moving average line. Once we have a measured move, you can apply Fibonacci extensions, the 127, the 161, and the 261. These help me to determine when to exit. They show me when the price is a little bit overextended. Now, back on April 6th, Costco was sitting at 293. So we put on a bull put by selling a 17 July 255. This is the 255 at $6.80. At the same time, we bought one at 245 for $4.80. So the net credit was $2. By buying one further out of the money, it protects us against a catastrophic drop. 10 days later, what we did is bought this credit spread back by buying now the 17 July 255 put at $4.08 and selling the 245 put at $3.03 for a net debit of $1.05. The $2 credit over here minus the $1.05 gives you 95% profit, or $95 on one contract. This is approximately 50% of profit on credit. So this is for one contract. For 10 contracts, it's $950. For 50 contracts, that's close to $5,000. Of course, this is something that I just got out of. This was a profitable trade. And I have to say that past performances is no guarantee of future results. But we have a very, very good track record. We've been in business for 10 years. Over those 10 years, I have averaged about 75% winning trades. Here's the next one we got out of just today, and that was a bull put spread on the SPX. You can see that we had the SPX was oversold down here. It was below the 5, and it came up and made a measured move, and that's when we got in. The 5 was over the 8. And the reason I got out before we got up to the Fibonacci's is I had made what I believe was an excellent profit already. So why stay in any longer? Probably what I'll do is go ahead and once I got out of this one, get into one further out. But we got into this on April 7th when the SPX was at 27.15. It was a bull put. We sold the 15 May 2400 put at 66.40. and bought the 2390 put at 64.50 for $1.90 credit. And this is what I'm saying. A lot of people look at this, a lot of people look at this premium and say, well, why not just sell that directly and take all that premium once it decays? Well, if it doesn't decay and it goes in the opposite direction, you have unlimited loss. And that's not the kind of conservative trading I like to do. We got out just this morning on April 17th, where we bought back the 2400 put at $20.85 and sold the 2390 at $20 for a net debit of 85 cents. The $1.90 minus 85 is a $1.05 profit, or $105 for one contract, $1,050 for 10 contracts, and over $5,000 for 50 contracts. This again is what we do on a regular basis. What I'd like to do now is go over to my website, and we have been in business for 10 years. What I want to show you is if you scroll down right here and click on this button, you can either view or download the three principal method, which is basically a blueprint of how I trade. The other thing, at the end of this video, I'm going to have the thumbnail for viewing. I have a 12-part series which breaks this down into very great detail, showing you exactly how a professional trades. Now, ultimately, I would love to be your mentor. Our membership is priced reasonably. It's monthly. It's recurring. You can cancel at any time. But basically, with the membership, what you are getting is you are looking over my shoulder as I trade. When I see a good trade, I will send out a text and email alert directly to you. We publish our position list, so everything we do is right there. We don't hide any trades. The other thing is we have 4 meetups a month, or once a week on Tuesday. We get together for about an hour. I'm in charge of it. I usually teach for about a half hour, then we open it up for questions. We look at all the current trades we're in, and I talk about what I see and how we're going to manage these. If you can't make it on Tuesdays, this is always recorded and posted on the website. You get my entire master suite of how to trade Forex, how to trade stocks, how to trade options. This is an excellent opportunity for you. I hope you take advantage of it. But like I said earlier, please click on the thumbnail that's to the right here, and that will take you right to part 1 of my 12-part series. I hope you enjoy it. Thank you. Bye-bye now.